In question number 6, we have been given 5 adjustments: pass journal entries and prepare final accounts. So without passing journal entries also we can do adjustments and prepare the final accounts. That's how we can do for comprehensive illustration. But better understand, how do I pass journal entry? After passing the entry, how it could have been in the trial balance if you are aware about those adjustments beforehand. And from that adjusted trial balance, how can we prepare the trading and paying account and balance sheet? In such a manner, we will be solving these illustrations for your better understanding. Let's see here. Closing stock was valued at rupees 3,000. Whenever there is an adjustment for closing stock, you better adjust the opening stock also. The opening stock and closing stock both will be adjusted and routed through the purchases account, right? Opening stock will be addable with the purchases and closing stock is subtracted from the purchases. And further, the journal entry being very simple, right? For the stock. For opening stock, it should be addable with the purchases now. So purchases should be debited. Purchases account debit to opening stock. The value being 1,000 rupees. 1,000 rupees. And the journal entry for closing stock here being, closing stock account debit. Closing stock account debit to purchases. The value being 3,000. With that, adjustment related to the stock is over. Closing stock of stationery was valued at rupees 450. How do we handle for the closing stock now on stationery? Also similar. Usually whenever you are purchasing the material for the resale purpose, the purchases of material is now debited to purchases account. But for the consumption purpose, if you are getting any material, the debit item will be in the same item itself. If we could have purchased the stationery for the consumption, we might have debited the stationery account. Is that okay? That stationery in the trial balance being 800 rupees. What does it mean? This 800 rupees could have been the purchases. The purchased stationery may not be the expenses, right? Because only to the extent of materials consumed will be the expenses. So we have to do some additions and deletions with respect to the opening stock as well as closing stock of stationery with this to find out the expenses. The opening stock should also be addable with this, right? Isn't it? In the year beginning, we have 250 rupees opening stock. Then we purchased another 800 rupees worth of goods in that year. So 800 plus 250, we have 1050 rupees worth of goods. In the year, we came to know that 450 rupees worth of goods still pending. What does it mean? You have to subtract that. That's not as expenses, right? Those stationery remains unused. Could be usable the next year. Right, so anything usable the next year, for the current year it's not an expenses, it's an asset. So that 450 should be subtracted, then ultimate expenses for the stationery being only 600. Right, usually what you do, opening stock plus purchases minus closing stock is the expenses can be debited to the P&L account. In such a way you can post in the comprehensive illustration. But when you want to pass the entry, you need to understand the logic of entries also. The logic of entry here is just similar to the closing stock. So the opening stock of stationery will be addable with the stationery, no? So for that, the stationery account is going to be debited. Stationery account debit. Okay. Stationery account debit. to what? To what? Opening stock of stationery. Opening stock of stationery. Opening stock of stationery. Okay. Similar to the purchases to opening stock, right? The same will be repeated here too. Here too. Is that okay? But rather than purchases, I am debiting the item's name itself. Right. The value being 250. The value being 250. And for the closing stock, the entry being, come on. Oh, yeah, very good. So closing stock of stationery account debit. Closing stock of stationery account debit to stationery account. To stationery account. This value being 450. 450. Is that clear? 450. Now we have handled the adjustment entry for the stationery. Write off 100 for bad debt. 100 for bad debt. And provision for doubtful debt is to be maintained at 4%. To write off the bad debt, what we do? If we don't have any provision, first of all, the bad debt should be adjusted or routed through debtors. It will reduce the debtors balance. And then the bad debt will be routed through PDD if we have the provision. If we don't have the provision, it may not be debited to the P&L account. Right. Now, just pass the entry for the bad debt. First of all, it reduces the debtors balance. So, we have a debtors of rupees 1000. We came to know some of the debtors worth rupees 100 may not be realizable, could be assumed to be the bad debt. So, I am going to pass the entry for that. Yeah, come on, pass the entry for the bad debt. Bad debt is an expenses. So, I debit the bad debt. Bad debt account debit to debtors account. To debtors account. This value being 100. The next entry being this bad debt should be adjusted in the PDD account if we have the PDD. Do we have the PDD? Of course, we have the provision for discount on debtors. Provision for discount on debtors. Doubtful debts. Provision for doubtful debt is 150. How much bad debt we have? We have already 100 rupees bad debt, and currently another 100 rupees also we have. These 200 rupees could be now adjusted through the provision for doubtful debt. So the entry being PDD account debit to bad debt. How much is the bad debt? Existing 100 and new 100. So in total we have 200 rupees. So we can debit to PDD account directly 200 rupees. But the PDD is not sufficient enough. So 150 can be debited, another 50 could be debited to the P&L account. Or you can pass a separate entry. Debit PDD completely. That's a shortage of 50 to be now adjusted. Shortage 50 to be adjusted. While adjusting that, the fourth adjustment entry will also be incorporated. The provision for doubtful debt is to be maintained at 10%. Already I told you the method of preparing a working note for debtors. Debtors here being how much? 1000. From the 1000, what we have to do? We have to adjust the bad debt given in the adjustment. Bad debt given in the adjustment, which is 100 rupees. Am I right? So 900 rupees. From there, provision for doubtful debts should be maintained. The provision for doubtful debts should, to be maintained here is 10%, so 90. 810 we have. 810 we have. And fifth point is all about create a provision for discount on debtors. Okay. And reserve for discount on creditors at the rate of 5%. So minus provision for discount on debtors, which is 5% on this. 5% on this being 41 rupees. Am I right? So 40.5. I may round off to next whole number 41 rupees. Is that okay? Now I have passed the entry for bad debt given in the adjustment. The entry for bad debt given in the adjustment is nothing but bad debt account debit to debtors. And later, the bad debt should be routed through the PDD account. So PDD account debit to bad debt is over. And later, verify the amount required to be maintained in PDD. How much PDD we have to maintain for the next year? So we have to maintain how much? 90 rupees. Am I right? 90 rupees required to be maintained. Already there is a shortage of 90. Add up that. So we need to create 140 rupees by charging the P&L account. So we are going to debit the P&L account with 140 and create the PDD. So the entry here being profit and loss account debit, profit and loss account debit to PDD, to PDD. How much is that? 140. Either you can pass this way or in the previous class we passed this way, right? So PDD account debit to bad debt. The bad debt here being 200 rupees, but we have the PDD in the beginning only 150. The shortage is debited to the P&L account. Okay. And for the next year's requirement being 90, further the entry being P&L account debit to PDD 1990. In both the way we can pass. Both the way we can pass. No issues in that. No issues in that. Okay. So if you club these two, what is the ultimate entry? P&L account 50 and here is 90. If you sum these two, the ultimate value be 140 in P&L account. So P&L account 140 and PDD 150 in the debit and 90 in credit ends with 60 in the debit. Am I right? 60 in the debit. To bad debt. To bad debt. 200 rupees. 200 rupees. If you club these two entry, by the time also you will get the same entry. Okay, PDD account debit, PDD account credit, 200 minus 140 ends with the 60. Bad debt 200 rupees in credit and P&L account 140. So in either way you can pass. You should not have any confusions. Right. So rather than having a ready-made format, understand the logic to pass the entry in whatever the way you are asked in the examination. Is that clear? Now, I don't want to keep this anymore. For the understanding only this one is given. Right. Apart from that, we need to pass the entry for what? Discount on debtors also. Okay. So how much discount on debtors we need to maintain? 41 rupees to be maintained. 41 rupees to be maintained. Already we have how much discount? 50 rupees we have the discount. This discount is no more required. Right. This can be adjusted in the provision for discount on debtors the same way. And we need to create another 41 rupees. We have discount on debtors in the debit side 50. And we have already provision for discount on debtors given in the credit side of the trial balance, which is created in the opening or previous year itself as an opening. This 50 will be adjusted only in the 40 rupees. So I am adjusting that just similar to this entry. This entry. Okay, similar to this entry. How we usually charge the bad debt to the PDD? No, the same way. The discount on debtors is routed through the provision on debtors account. So, provision on debtors account debit to discount on debtors. The value being 50. The value being 50. Actually, discount on debtors being 50, but we have the provision of rupees only 40, running short of rupees 10. Am I right? How much we need to create for the next year? Another 41. So, how much we need to debit the P&L account to create the required PDD for the next year? Provision for discount on debtors 51 rupees. I now pass the entry for the provision for discount on debtors to be created in the next year for the requirement of the next year. P&L account debit to provision for discount. Provision for discount. Provision for discount. The value being 51 rupees. 51 rupees. This entry is similar to what? The creation of PDD, like both are same. Now, we have to handle with the reserve for discount on creditors also. Reserve for discount on creditors. Okay. Just erase this. Okay. Now, the reserve for creditors here being reserve for discount on creditors. Already we have how much discount on creditors? 35. That 35 should be first adjusted in which account? Provision for discount on creditors, running short of rupees 10 here because of adjustments. 35 should be charged to 25. Of course, the money is not capable of adjusting that, so 10 is there. What is the closing balance we need to maintain? 5% on creditors. So creditors is 10,000 rupees, on that 5% to be created, value being 50. Already there is a shortage of 10 and we need to create another 50. So in total we are in need of 60 rupees to be created for the provision for discount on creditors. For this, the entries are similar to this one, right? Provision for discount on debtors, provision for discount on debtors, you could debit to discount on debtors, right? Similarly, here discount on creditors and provision for discount on creditors will be taken, but it's just inverse, right? Just inverse. Let me see here. Discount on creditors, account debit to provision for discount on creditors. The amount to be adjusted here is 35 rupees. Then next entry being provision required to be created for next year's requirement, similar to this one but inverse. Okay, provision for discount on creditors, account debit to discount on profit and loss account, to P&L account. The value being 60 rupees. Hope you could now understand the passing the entries for all these adjustments. Is that okay? But of course, you no need to pass all these adjustments entries, but it is better to understand. Okay. Now let me incorporate these adjustments in the trial balance so that the adjustment could have been already incorporated before the preparation of the trial balance. If you could have used all these things, or if you could have passed the entry of these things before the preparation of the trial balance, how could be the trial balance? Let's see here now. One after one. Purchases debit, purchases credit. Debit means you have to add with the purchases, credit should be subtracted. Already we have purchases of rupees 5,000. With that, because of opening stock, 1,000 is added, 3,000 is subtracted. Now the adjusted purchases being 3,000. Adjusted purchases should be 3,000. Opening stock 1,000 rupees in credit. Already opening stock is given in the debit, gets eliminated. We don't have the opening stock. And closing stock, new stock comes in. So rather than opening stock, now it becomes closing stock in the trial balance. So trial balance will not consist of opening stock. Only closing stock might have been included in the trial balance if the entry for the closing stock and opening stock could have been passed, where the opening stock and closing stock could have been routed through the purchases account or sales account, also predominantly purchases account. Of course, there is no harm in adjusting that in the sales account. Okay, logically adjusting in the purchases account is better. And then stationery debit and stationery credit. Debit should be addable, 800 plus 250. Credit should be subtracted, 450 should be subtracted. The ultimate stationery value being 600. Hope so you can understand. And opening stock of stationery 250 in the credit side. Already we have opening stock in the debit side. So this opening stock got eliminated. Instead of that, what we get now? Closing stock of stationery. So rather than opening stock of stationery, the trial balance, now we have closing stock of stationery of rupees 450 in the trial balance. Bad debt account debit. Okay, already bad debt we have 100 rupees in the debit. With that, this 100 rupees is also added. 100 plus 100, 200. 100 here is, 100 here is. So the total value be 200. From there, this bad debt credit should be subtracted. So the bad debt will be eliminated. Hereafter, we don't have the bad debt account. And in case of debtors, we subtract 100 rupees. Originally, we have 1,000 rupees. Because of crediting the debtors account with respect to the bad debts requirement, now the debtors being only 900. The debtors being only 900. And provision for doubtful debts, debit 200 rupees, credit 140. So naturally what happens? We have a debit balance of PDD 60. Okay, already we have 150 here. From that 150 rupees credit, this 60 debit is subtracted. Then we will end up with how much? 90. Hope so you could understand. So 150 in the credit side and 200 rupees in the debit side means it should be subtracted, and another 140 should be in the credit side should be added. So by adding or by summing and subtracting these three items, you will get the ultimate provision for doubtful debts being 90. Am I right? Are you getting this? Yeah. The next will be profit and loss account 150. Profit and loss. Profit and loss is meant for whom? Owner only now. Whatever the profit or loss we ultimately get, it should be adjusted only in the owner's account. So we can adjust that in the owner's account. Owner's account is named as capital. In that capital, this profit and loss given in the debit side should be subtracted. Right? Debit means subtracted. And another P&L account is also there in the debit side, that should also be subtracted, which is 51. And another P&L account is also available here, 60 in the credit side, that should be addable. Credit means addable, debit means subtracted. If you do all these adjustments, and what could be the closing capital balance here? Come on. 4,869 will be the answer. 4,869 will be the answer. Okay. Now, discount on debtors 50 rupees. Already we have discount on debtors 50 rupees in the debit. Because of crediting, it gets eliminated. And provision for discount on debtors is there. Provision for discount on debtors, originally 40 rupees in the credit side. And because of this provision for debtors debit, we have to subtract, right? So 50 should be subtracted. And again, provision for discount on debtors given in the credit side should be addable, which is 51 rupees. Credits are added and debits are subtracted. Then ultimate value being 41. Am I right? Will you be getting 41 rupees? So this is now converted into 41. This is now converted into 41. Right. Now, discount on creditors debit. Already discount on creditors in credit side we have 35. Now it gets eliminated completely. This will be eliminated. And provision for creditors 35. See here, provision for creditors being given in the debit side 25. And because of this provision for creditors in the credit, it should be subtracted, right? 35 should be subtracted. Again, provision for creditors given in the debit side should be addable. Should be addable. The value being, this value being 60, right? Yeah. So what is the ultimate value?
70.
Is the last one is 60 correct or not? Yeah. What is the ultimate value? 50 rupees. Okay. 50 rupees will be the value. I'll change this to 50. Okay. This is 50. Hope you could now understand. Now if I prepare the trial balance, this trial balance is called adjusted trial balance. This trial balance is called adjusted trial balance. Come on, get me the adjusted trial balance value here. Make it faster. Make it faster. What's the value? Totally done. Use the calculator. Make it faster. Use the calculator, man. It's not possible to calculate that mentally. So many numbers. Huh? Debit. Debit side?
18,000.
Exactly 18,000. Also 18,000. It matches, right? It matches. See, this is called adjusted trial balance. Okay. You can pass the, probably you can pass the, this one, adjust means transfer entry, and you can post this also. You can post it. Okay. I'll just do some adjustment here. Now, for what we have to pass the transfer entry. Those nominal accounts will be routed through transfer entry. For the all the real and personal account will be directly written in the balance sheet. Right. Let's see here. Trading and P&L account, and then balance sheet, and then balance sheet. Okay. Now, trading and P&L account, and then balance sheet. Actually, we have to pass a transfer entry and then you post this. But I'll just directly post this and then I will pass the transfer entry later. Come on. Purchases, carriage in. These two will be what? Items debited to the trading account. So the entry being purchases account debit, purchases should be in the debit side, value is 3000. Carriage in, the value being 1000. Admin, selling expenses, both will be debited to P&L account. Admin 1000 rupees, selling 1000 rupees. Fixed assets, investment, debtors, cash, stationery, stock of stationery, except stationery. Okay. These things are assets, so I put that value in the asset side. Right, in the asset side. Fixed assets, the value being 4000. Investments, the value being 2000. Debtors 900 in the inner column because it has two adjustments: provision for discount on debtors and provision for doubtful debts. Okay, and I'll just leave the space here: PDD as well as provision for discount. Provision for discount. Then we have cash, the cash value being 1000. What about stationery? Stationery and expenses should be debited to P&L account. Consumption of stationery 600. And closing stock of stationery, closing stock, and provision for discount on creditors. First of all, we will try to finish up these two: closing stock of stationery and closing stock. Both our assets will be posted in the asset side of the balance sheet. Closing stock of stationery, closing stationery. The value being 450. How much is that? 450. And stock in trade, that closing stock of material meant for business is always named as stock in trade. The value being 3000. And provision for discount on creditors should be adjusted from the creditors. So creditors account. From there we have to subtract the provision for discount on creditors. 50. Provision for discount. Debit side over. In credit side we have sales. Sales should be in the trading account, the value being 8,000. And capital here 4,869. 10% loan creditors, both are liability. 10% loan, the value being 4,869. Oh, okay, 4,000. Creditors being 1,000, from there 1,000 is 50 rupees is subtracted, so 950 is the ultimate value. Provision for doubtful debts and provision for discount on debtors, already left the space for that. 90 and 41. What is the ultimate value?
769.
769. 769. Discount on creditors was already eliminated. We don't have the discount on creditors at all. Right, eliminated already. Now, if I want to pass a transfer entry, the transfer entries are for what? Only the items recorded in the trading and P&L account, right? So I just pass the transfer entry for the items given in the credit side. So for that, the journal entry being credit side of the trading account. The entry being sales account debit. Sales account debit to what? Trading account. What is the value? 8,000. And trading account debit items, purchases and carriage. What is the journal entry for that? Very good. So trading account debit to purchases to carriage in. The value being 4,000, 3,000 for purchases and 1,000 is for carriage in. Then the entry for admin and selling and distribution. Yeah. P&L account debit. P&L account debit to admin to selling to stationery. The value being 1,000, 1,600, 2,600. Now tally the trading and P&L account. 8,000, 8,000, 4,000 should be GP. Now if I tally this, 1,400 should be transferable to a balance sheet addable with the capital 1,400. For the GP, journal entry being what? Yes, GP, trading to GP and GP to P&L account are simply okay. P&L account debit to, what's the entry here? P&L account debit or what is the entry? Trading to GP and GP to P&L account. Then ultimate entry being trading account debit to P&L account. The value being 4,000. Finally, whatever the balance available in P&L account is transferred to capital account for the journal entry being P&L account debit to capital. This value being 1,400. So you have to be strong with the transfer entries also. So at the professional level, in most of the advanced sums, no, you will have such a calculations also. Come on, get me the balance sheet total.
11,209.
What about the total of capital? Is it 6,269? Okay, 6,269. If you total this, 11,219. 11,219. I have not skipped any routes. I explained everything in a proper channel. For your examination, of course, you no need to do this way. Okay, you can directly work out as you think. Now, the question is, if the provision for discount and returns given in the credit side of the trial balance, what you have to do? Only that one. Only that one. Provision for doubtful debts as well as provision for discount and returns available. What does it mean? All the adjustment related to the bad debt and the discount and returns over. The provision given in the trial balance is nothing but for the next year. That will directly go to the balance sheet. See, whenever any adjustment items appear in the trial balance, it will go to only one place. It will go to only one place. You have to be careful with that. So here I have explained that in detail. In subsequent learning at the professional level, no. Most of the times their questions may be surprising. Some of the adjustments could have been incorporated in the trial balance itself. So you may be surprised why the closing stock comes inside the trial balance. Why the provision for doubtful debts comes only in the trial balance without any bad debt or any provision for any discount and returns. Then how do I handle that? Now all these questions could be addressed by learning this way of passing journal entry and preparing the adjusted trial balance and going for the final ones. Of course, for the examination, you can skip these points directly. You can prepare the trading and P&L account and then balance sheet. Okay, come on, if you want to make a copy of this, make it fast. For the trading concern is quite a bit easy. Where we are purchasing, in case of furniture showroom, they purchase the table, cupboard, whatever it may be, chair, everything, and then it is sold. It is sold, right? Purchased and sold. Buying the finished goods and selling as it is coming under trading concern. But when it comes to the manufacturing entities, they purchase the raw material. For example, they purchase the wood, steel, plastic, etc. That will be converted into table, right? That will be converted into table, chair, like. This processed item will be transferable to the next division, where it may be kept in the showroom and displayed and sold finally. So in this case, the conversion process, that wood is converted into finished goods, no, will be taken care in a separate division called workshop or factory. Any items, income or expenses, whatever it may be related to the factory, will be separately recorded in a new account called manufacturing account. This is called manufacturing. Okay, manufacturing. In this manufacturing account, we spend the money for purchasing the raw material, and we convert that raw material into finished goods by introducing labor cost, some other machine related cost, factory related expenses. Actually, in CMA Foundation, we have the costing paper, especially cost sheet. In that cost sheet, we call this being the factory overheads. Any cost you incur in the factory will be called as factory overhead. All these expenses will be grouped and posted in the debit side of the manufacturing account. Some of the examples are here related to this. Some of the examples. Okay. Factory expenses like rent, depreciation, salary. Sir, rent, depreciation, salary, everything will be debited only in the P&L account, sir. No. Here, anything related to the workshop will be debited only in the workshop account. The workshop account is named as manufacturing account. While preparing the cost sheet, that will be coming under factory overhead. Up to this point, we find out the cost of production. So to produce the table, what is the cost we incur? The material cost, the labor cost, and the depreciation of the machines used for manufacturing this one, salary, rent. Will the rent come here? Comes here. When if the rent is meant for the factory, then it will come here. Is that okay? All the expenses related to the factory will be posted in a separate account called manufacturing account. From there, it will be transferable to trading account. Once it is over, then it is transferable to the trading account. Okay, the finished goods will be transferred, the table and chairs. And with the additional expenses like admin and showroom will do selling process. Okay, showroom, otherwise sales expenses. This process is coming under trading account. This process will come under P&L. So for the manufacturing company, the preparation of final accounts is now extended by one more subdivision called manufacturing account. The manufacturing account resembles like normal trading account, but it's related to the factory. All the expenses related to the factory will be debited in the manufacturing account. Usually, the source of the manufacturing account is the wages, means the wood and steel, the raw material, and then the raw material is converted into table and any other finished goods in the manufacturing division in the workshop by introducing the additional wages and any factory equipments as well as the support of the factory. And once it is over, it will be transferable to the finished goods. Means trading account, and in trading account only the sales happens, and then we'll get the GP. That GP is transferred to the P&L account. So let's see here. Okay, let's see here the format. Okay. Now, how should the manufacturing, trading account and P&L account as well as balance sheet? Manufacturing, trading and P&L account. Trading and P&L account. And then finally balance sheet. Okay. In manufacturing account, we introduced the raw material purchased and wages and salary. Wages and salary or salary, whatever it may be related to the factory. Carriage in. All the item usually you might have studied being the debit item of the trading account will be debited in the manufacturing account. Carriage inwards, wages, power, coal, whatever it may be you might have studied, no? Could have been debited in the trading account. Instead of debiting that in the trading account, it's going to be debited only in the manufacturing account, right? Carriage in. The carriage in represents the carriage amount paid, carriage in inwards amount paid to bring the raw material to the workshop. So it's a part of the raw material cost, not the finished goods cost. Up to the point of production will be debited to the manufacturing account. All the manufacturing expenses like factory rent, okay, factory rent, and electricity, power, repairs, all these things will be debited here. Now on closure, see in the factory while processing, no, some scraps may come in, right? If any scraps comes in, then that will be credited here in manufacturing account itself, right? Sale of scrap. Okay. For example, I introduced a material worth rupees 1 lakh for the manufacturing of certain commodity or certain product. After the process, we get some scraps of the material that was discarded for rupees 0.2 lakhs. So then what is the price of the material we have used here? Only 80,000 rupees. Am I right? It is not 1 lakh. So any unused or any scrap sold, just imagine with that gold. You want to manufacture or produce any gold chain. You have given around 50 grams gold. Okay, when the chain is made ready, the chain costs us only 45 grams. Will you be happy with that? What will be your response? What happens to the another 5 grams, sir? Sir, damages. Give me the dust also. Now 5 grams, 1 gram is equal to 4,000 to 5,000 rupees. 5 grams is almost 20,000 rupees. Do you want to lose that? Any scrap is there, whatever the value realized will be subtracted from the cost of production. The chain value is now subtracted. Whatever the cost we incurred for producing the chain, that value should be subtracted. What is the cost of production of the chain? Material, wages and all. Any scrap is there and any amount realized from scrap should also be subtracted from here. Is that logic? Are you able to understand? Now, this is the sale of scrap. Sale of scrap should be credited here. So I'll just write it here. Sale of scrap. Once the production is over, whatever the value you get now, that will be transferable from trading account to, sorry, this is transferable from manufacturing account to trading account. Second block is a trading account where I am transferring here. Cost of production, finished goods. Okay, we don't purchase. Usually, being the trading concern, we purchase the finished goods from outside, but I am manufacturer come trader. I manufacture the finished goods required for my business myself, not purchased from the outside. So whatever the things available in the workshop is now transferred to showroom. So the transfer will be happens from here to here, means from the manufacturing account to trading account. Trading account. And you will get the sales here. You will get the sales here. And on tallying this, you will get the GP. Then thereafter, you transfer the GP to P&L account and find out the net profit. The net profit is transferable to balance sheet. Hereafter, it's normal. Only the additional point you have to note it, this one. And in trading account, we don't have purchases. We don't have purchases because the finished goods are transferred from the workshop to showroom directly. Now, in this case, the stocks are for three varieties. One is raw material stock, another one is finished goods stock, another one is halfway through, work in progress. It's not raw material as well as it's not finished goods. It's anywhere between these two will be called as work in progress. And only the finished goods component will come in the trading account. So in trading account, opening stock of finished goods will come, and here closing stock of finished goods will come. Is that okay? This will come. And in case of raw material and work in progress, these two will come in the manufacturing account. Where? In the manufacturing account. Opening stock of raw material as well as work in progress should be here. And closing stock of raw material and work in progress should be here. Is that clear? Hope so you could understand. So these are the small points you have to understand. Semi-finished goods is otherwise named as work in progress. You are absolutely right. Semi-processed, incomplete goods, right? So you have to understand the preparation of the manufacturing account, trading account, and P&L account, and then balance sheet in case of manufacturing entity. Is that okay? Come on, make a note of it. Okay, a unique name, TOPA. Okay. Before I proceed preparing the final codes for the manufacturing entity, let me finish up the adjustments first of all. The following additional information is available: raw material, finished goods, and semi-finished goods at the year end is given. Raw material being 162, finished goods being 181. Work in progress being 78,000 rupees. This is closing. I just note it down here. Salaries and wages unpaid were rupees 9,000 and 20,000. So outstanding wages is there, that should be addable. Outstanding salary should also be addable. The outstanding salary being 9,000 and outstanding wages being 20. Am I right? Right. Machinery to be depreciated by 10% and office furniture by 7.5%. Okay. So the office furniture will be depreciated by 7.5%. Plant and machinery should be depreciated by 10%. I just marking the adjustments here to make the space available. Right, that's all. The PDD being 1% on sales. PDD closing being 1% on 6, right? 16,720. Office premises occupy 1/4 the total area. Rent is 60, right? The rent paid for the whole area being 60, out of that, office premises being one fourth, 15,000. Then the balance may be 45,000, right? 3/4. Balance being related to factory. Lighting is to be charged as 2/3 to factory and 1/3 to office. So lighting charges 13,500. Out of that, 2/3 is for factory and balance 1/3 is for office. 2/3 of 13,500 being 9,000 and 1/3 of which being 4,500. I have marked all the adjustments in the trial balance itself, so I don't want the adjustments anymore. Right. Now I will prepare the manufacturing account. Manufacturing account. Trading account. Trading account. Profit and loss account. And finally, balance sheet. So we need to have 4 blocks. One extra block we study here is all about manufacturing. Is that okay? Manufacturing. Now, balance sheet. We'll finish up posting the stocks here first of all. Raw material, work in progress, finished goods. Among the 3, raw material and work in progress will be posted in the manufacturing account and finished goods will be posted in the trading account. Is that okay? Here, opening stock of raw material being 2,10,000. Opening stock of work in progress being 95,000. Closing stock of raw material as well as work in progress 1,62,000 and 78,000, which is given the adjustment. So 1,62,000 rupees and 78,000. Okay. The finished goods will be posted in the trading account to opening stock. To opening stock, the value being 1,55,000. Closing stock should be 1,81,000. 1,81,000. Stocks over. Let's move on to the sundry debtors posted in the asset side. Sundry debtors, the value being 2,40,000. Anyhow, we have provision, right? So I will put the value in the inner column minus PDD. Carriage in will be debited to the manufacturing account. The usual items debited in the trading account will appear in the manufacturing account hereafter, right? So carriage in 15,000. BR asset, in the asset side BR, the value being 1,50,000. 1,50,000. Wages and salaries. Wages should be in the debit side of the manufacturing account. 130 plus 20, 150 will be posted in the debit side. The 20 being the outstanding is a liability. I will put that value in the liability side. So outstanding wages. The value being 20,000. Salaries will be an item of debit in P&L account. So here salaries. The salary being 1,09,000, 1 lakh, and including outstanding, it is 1,09,000. The outstanding salary will be a liability, will be posted in the liability side. So outstanding salary. This value being 9,000. Telephone and postage will be debited in the P&L account related to the admin expenses, right? So telephone, the value being 10,000. Repairs to plant will be debited in which account? Manufacturing account. Plant, machine, whatever it may be, will be available only in the workshop. So any expenses related to that will be debited to the manufacturing account. So repairs to plant. Repairs, plant, the value being 11,000. Repairs to office furniture. Office will be item of administration, so debited in the P&L account. Repairs to office furniture. Office furniture, the value being 3,500. Purchases should be debited in the P&L, not in the manufacturing account. Usually, we'll debit that in the trading account. When we prepare the manufacturing account, all the usual debit item in the trading will appear in the manufacturing account. Here also the purchase is going to be posted in the purchase manufacturing account. The value being 8 lakhs 50. 8 lakhs 50. Cash at bank, an asset. So bank, the value being 1 lakh 70. 1 lakh 70. Plant and machinery, asset. So plant and machinery, P&M, 7 lakhs, depreciation being 10% on that, 70,000. After subtracting the plant and machinery to be posted in the balance sheet being 6 lakhs 30,000. I request you to post the full value and subtract 70 in the inner column and post it outside. Though I may record only the final value. And depreciation of plant and machinery related to the manufacturing, right? So it will appear in the manufacturing account. Any assets related to the factory and any expenses related to that factory items will be debited only in the manufacturing account. Either repair or rent or lighting, electricity, then depreciation, everything will appear only in the manufacturing account. The value being 70,000. We have office furniture, the value being 1 lakh and depreciation that being 7.5%. So after depreciating 7,500, the final value being 92,500. Very good. Where the depreciation will come? In P&L account, office furniture, no? Depreciation of furniture, office furniture. In P&L account, 7,500. Rent, total 60. 15 is meant for what? Office will come in the P&L account of office. 45 related to the manufacturing will come in the manufacturing account. So rent for factory will be debited in the manufacturing account, 45,000. Rent for office will be debited in the P&L account. Rent for office, the value being 15,000. Then lighting also segregated this way: 9,000 for factory, 4,500 is for office. So the lighting will go to the manufacturing account debit side. So lighting, factory, 9,000 rupees. And lighting in the debit side of P&L account be 4,500. 4,500. General expenses. Come on, tell me where will it come? Usually, in the case of general, will come in the P&L account, right? General expenses in P&L account, the value being 15,000. And in credit balances, sundry creditors, balance sheet, sundry creditors, liability side, the value being 1,50,000. Bills payable also being in the liability side, the value being 75,000. Commission is an income. Where will it come? Come on. P&L account, general income. 4,500 should be in the P&L account. Provision for doubtful debts, PDD. PDD given in the adjustment 16,720 minus PDD given in the trial balance 16,500. The amount debited in the P&L account being 220. Then provision is subtracted from the debtors. Okay. 2,40,000 from there 16,720 is subtracted. Come on, get me the value of debtors here. 2,23,280. We got the debtors here. Capital account. In the balance sheet, capital account liability side 10 lakhs. Sales will come in the trading account. Sales 16,72,000 rupees. Current account of TOPA, where will it come? Balance sheet, liability side. Current account being 85,000. What does it mean? You might have studied in partnership at your +2. Fixed capital and fluctuating capital. In case of fixed capital, the original capital invested will be kept separately as fixed capital. Subsequent years transaction like drawings and further capital, further investment, interest on capital, salary, everything will be routed through another account called current account. Similarly, this is not only for the partnership, it is applicable for sole trader also. In this case, the TOPA being the owner says that I invested 10 lakhs, you keep it separately. Subsequently, I may introduce some additional money or I may withdraw some money also now and then. Or any profit and loss is there also be routed through that current account. Such a way he can maintain a separate account. Here that separate account is available, named as current account. That value being 85,000. And the sale of scrap, where will it come? Manufacturing account. Sale of scrap. Sale of scrap. That value being 25,000. We have posted everything. Come on, finish up tallying the manufacturing account. How much is that? Huh? How much is that? The balance you will be getting here. No. What is the balance? Come on. 11 lakhs 90 being the balancing figure, I think so. Should be transferable to the trading account because this is cost of production. Production is over. Then this is transferable to trading account. Cost of production transferred from manufacturing account. What is the total? Come on. Eleven lakhs 90. What is the total value? No, it's not 12 lakhs 93. Something different number. I think so. 11 lakhs 60. 60,000. 1160. Is it correct? 16,000. 11 lakhs 16,000. Verify this. Already 11 lakhs 19,000 is there in the credit side. How will 12 lakhs 15. 14 lakhs, 14 lakhs, 50, 5,000. Okay, 14 lakhs, 55,000. Be careful with that. Okay. Now on tallying the trading account, the balance being 18 lakhs 53,000. 18 lakhs 53,000. You get the GP. Here the GP being 5 lakhs 8,000. I transfer the GP to P&L account 5 lakhs 8,000. 5 lakhs 8,000. If you tally this, 5 lakhs 12,500 and 5 lakhs 12,500, you will be getting the net profit here. Hope the net profit being 3 lakhs 47,780. That will be addable with current account 3 lakhs 47,780. Then current account becomes 4 lakhs 32,780. Get me the total of balance sheet. Yeah. Hope the total being 16 lakhs 86,780. 16 lakhs 86,780. Are you getting this answer finally? We have missed to post the stocks here, these three. Okay, I'll post all these things. Stock of raw material, work in progress, and finished goods. 1,62,000, 78,000, 1,81,000. Is that okay? Is it matching now? Okay.